We have seen many big businesses with multinational operations which domicile themselves in tax havens in order to save on taxes. To put an end to decades of tax competition between governments, we are now seeing something called as global minimum tax.
To enlighten us about this Pillar 2 Global Minimum Tax, we have with us CA Rohit Sharma S. I request CACR Vasant Kumar, Shivamogga CA Association President, to escort him onto the dais and welcome him with the book.
CA Rohit Kumar has over 14 years experience in serving large Indian corporates and multinational clients in the field of audit, direct taxes, international taxation and M&A. Rohit has presented various papers in conferences. He has written articles on various taxation issues in leading taxation journals. We welcome you, sir.
Hello. A very good afternoon to everyone here.
Good afternoon, sir.
Good afternoon. And I thank KCA for giving me an opportunity to speak on this very interesting topic, which in due course will, of course, become relevant to everyone doing income tax practice in India. So let me give an overview. What is Pillar 2? Pillar 2 is a system of tax where, of course, so many years you would have seen all the technology companies are headquartering themselves in Ireland. Let it be Facebook, let it be the Googles of the world, let it be the Amazons. All of them have majority of their IP situated in Ireland, and they are ending up paying little or no tax in that country. So apart from just incorporating a company in a tax haven, they don't really have people or substance in that country. So like globally they may end up paying only 3% effective tax, though their profitability may be in millions of dollars. So this topic, Pillar 2, is a system, it's a coordinated system of taxation, whereas countries across the world, they have decided to come together and see how the race to the bottom of 0, 3, 6% kind of taxes is no longer there. Many of our senior professionals here would be aware that about 30, 40 years back, the peak rate of tax in India was very high. And globally, the global average tax rate was 40%. Today, the global average tax rate is about 23%. And if we continue or allow this to happen, slowly 23 will fall to 20, 15, 10, and then it becomes some sort of a tax competition where countries are going to get more investment just by giving a lower tax rate. So this Pillar 2 is a subject wherein the OECD is driving it. 141 countries are a part of something called as an inclusive framework. And as part of the inclusive framework, India is also a member, and they have agreed to implement this. So this is going to come to India and be a law in 2024 or at most 2025. With this brief introduction on the topic, I'll maybe go to my slides now. Okay. So, all of you would have seen a lot of changes in the tax laws in the last few years. There was something called as BEPS 1.0, wherein a lot of action plans were there and a lot of changes were made so that international tax systems were revamped so that substance-based taxation was ensured. Then they moved to Pillar 2, wherein there were BEPS 2, wherein there were two pillars, Pillar 1 and Pillar 2. Pillar 1 was a system wherein, again, the objective was to move taxation to where the revenues are being generated from. Example, significant economic presence. Like you may have US selling products in India without a company here through online, or you may be playing a game sold by a US company to an Indian resident. The US company is actually generating tax from India or income from India, but not paying taxes in India. So the Pillar 1 was a set of rules which kind of addressed that situation, wherein all the taxes on such overseas income is also now being brought to India by way of significant economic presence. that is already there in law in India as we speak. Now what happens next? We go into something called as Pillar 2. So what is Pillar 2? Pillar 2 is a framework wherein countries have globally come together and they have now said that we will minimum take 15% tax from wherever jurisdiction you are operating. For example, all of you would have been aware, until last year, Dubai never had any taxes. Dubai had zero taxes. Suddenly they introduced a law saying, okay, we are going to have a 9% tax rate. What was the reason? Why did they do it? They could have continued to be a 0% tax rate country. The reason why they did this was because of Pillar 2 legislation coming into force from 2023 and a lot of countries trying to implement it from 2024 and going forward. Now what needs to be seen in Pillar 2? You need to see it on a country by country basis. So let me give you an overview. So the Pillar 2 provides a coordinated system of taxation. What do we mean by a coordinated system of taxation? So far, Indian tax authorities were chasing Indian companies. Tomorrow, after Pillar 2 becomes law, a Dubai tax authority can also look at taxing an Indian company for income earned in Dubai by a system called as coordinated system of taxation. So the Dubai tax authorities, Indian tax authorities will work together to ensure that at least 15% tax is paid by a particular entity in a jurisdiction. So that is what is called as a coordinated system of taxation. Now what is the objectives of Pillar 2? The key objectives of Pillar 2 was to end the race to the bottom. So we had, all these tax havens where they were giving 0% rate, and now, they are taking away a country's actual, revenue by just giving a 0% rate, and Ireland was probably the best example of it, wherein companies like Facebook, Google, and Amazon, they have not been paying their due taxes just by taking a shelter of a particular country. So going forward, no country will be able to protect you from taxation. And the law will be substance-based. Okay, you are allowed to go to Ireland, set up an entity there. But ensure you have 1,000 people, 5,000 people, 10,000 people, 1 lakh people to support the kind of operations or revenues you are showing in Ireland. It cannot be a paper company with 1 lakh crore turnover, 10,000 crore turnover, 5,000 crore turnover. That is the objective of Pillar 2. Now again, why and how does it impact developing countries like India? Now, as things are going, you are aware that India is going to become a superpower for the world. Today, Indian entities are not just restricted to India. They are spreading their wings across the world. 25 years back, there were hardly few companies who had global presence. In Bangalore, we had Infosys, we had Wipro, we had a lot of Indian outbound IT companies who had presence in more than one country. Today, that is not the case. The way business is happening, the way e-commerce is happening, the way online gaming is a business is happening, companies are required to have either physical presence across the world or have a virtual digital presence across the world. And because the world has become a small village, there is a need that all countries come together and adopt this coordinated system of taxation. Now, India is a signatory to Pillar 2. India has agreed to bring this into law. So, rest assured all of you, by next budget, 2024 budget, you will have amendments on this in the budget. If not, there will be a special bill or a special act passed to bring this into law. So I have put on the screen two statements. One is made by Netflix and another is made by Google. So what is Netflix saying? Netflix is saying, I can tell you that with Pillar 2, we will have to hire an army of accountants just to guarantee that there will be consistency in complying with Pillar 2 and calculate the effective tax rate across the 170 countries we are operating in. Today, Netflix has presence in 170 countries. whereas they are not paying taxes in all the 170 countries. Let's look at Google. This is a statement made by Sundar Pichai, CEO of Google. So if a tax matter is reaching a CEO of the world's largest search engine, it is not a small change. It is a change everyone has to take into account. What is Sundar Pichai saying? Global tax deal will make no difference to Google in Ireland, as the company remains committed to investing and adding staff to its European hub here. What he's saying is, Google is not a paper company in Ireland. We are going to add a lot of people so that Pillar 2 does not impact us. Which means they are already re-evaluating their business model. They are already re-looking whether their IPs should be in Ireland. They are already looking at how much tax they should pay in Ireland. Now, let's see the journey, how Pillar 2 has started. This started somewhere in 2020 during the pandemic. And there was a blueprint of this. In 2021 October, 137 countries said, yes, we agree with this law. We want to work together. 137 tax departments of countries want to work together to ensure that this becomes a law. In 2022 December, which is 3 months back, the returns were notified. What kind of data the government should capture so that they are able to identify how much is the tax payable under Pillar 2. Those returns were identified for public consultation. In 2023 February, like how we have circulars and notifications issued by our income tax department to us, the OECD has started releasing circulars or notifications to clarify what are the challenges or what are the pain points in Pillar 2. Last week, Singapore also made a statement that by 2024, they will also introduce this act in the parliament, and by 2025, they will make it law. US is still thinking about it because US's concern is, okay, if China tomorrow doesn't do this, I will lose revenues. So US is waiting and watching. Countries like UK, they are saying, yeah, we understand, but it is very complex. Let us take time and understand this law. So a lot of the EU countries have given a statement that by 2023 December, they will make this a law, at least in EU, and from 2024 it will be applicable in the EU region. Now, what are the exclusions from Pillar 2? So when I say exclusions, to whom does this not apply? Right, like how we have exemptions in Income Tax Act, we have exclusions from Pillar 2. So what are the exemptions? Anyone having a turnover of 6,600 crores or less, those companies will not be impacted. So it will only impact the Tatas, the Reliance, the Infosys, Wipro, anything which has revenue of more than 750 million euros. In INR terms, it is 6,600 crores. Second, it does not impact individuals. It only impacts organizations. So, let us say if Mr. Ratan Tata, if he individually owns Tata Steel, Tata Motors, Tata Tea as 4 verticals, this law will not apply to Mr. Ratan Tata as an individual, but it will apply to each of the companies below him. So as an individual, no additional tax, Pillar 2 does not have any impact. At the same time, there are some exclusions given where your operations are very small, where there is you may be a company having 10,000 crore turnover in India, but in Sri Lanka you may have only 10 crore turnover, for example. Then this Pillar 2 will not apply to your Sri Lanka operations. You may be an Indian company having 10,000 crore turnover in India, and let's say you have a Sri Lanka company with 1,000 crore turnover or 1,000 crore business, then it becomes applicable to you. So you have to see, one, whether it applies at the parent level. Two, if I have subsidiaries across the world, which of my subsidiaries it will apply and which of the subsidiaries I can claim an exemption for. Third, it also doesn't apply to governments. Like if we have governments doing business, operating airports, operating ports, it doesn't apply to governments. It does not apply to non-profit organizations. It does not apply to pension funds, investment funds. It does not apply to private equities. It does not apply to venture capitalists. It only applies to proper businesses. When I say proper businesses, it is of the likes of, something like an Infosys, a Wipro, a Tata Steel. A company having proper business operations is what's applicable. It does not apply to fund managers, or it does not apply to the Sequoias, the Blackstones, the KKRs of the world. Now, how is this relevant from an India perspective? This is a very interesting slide. I would draw your attention to this one slide. Now, India, you would have observed, across the last few years has slowly phased out all the incentives. 10AA sunset clause is there. No tax holiday for any software company going forward. Section 35 linked, 150% deduction, 200% deduction, all of them are being phased out. There are only one or two sections in the Income Tax Act which have a weighted deduction. For example, 80JJAA is one section which gives a weighted deduction today. So India has anticipated these laws, because of which they have themselves phased out all the benefits available. Now, for example, there was a time when a company like, say, an Infosys may have had 10,000 crore profit, but may have not paid 30% tax on it. The reason being, they would have claimed a deduction under section 10AA, saying all my income is from exports, no income tax, exempt. In that case, Pillar 2 will become applicable to Infosys. They will say in India, though Indian tax rate is 25%, because of the 10AA deduction, you have paid zero taxes. Because of zero taxes, the other countries in the world with which Infosys is doing business, they will say, I will recover this 1,500 crores from you. How they will recover, I will show you in the coming slides. Now, before we get into a lot of detail, we will start with some basics so that we understand what the law is about. There are certain definitions, like how our Income Tax Act has section 2, which defines all the important terms. There are also key terms defined under this Pillar 2 regulation. Now, what is an entity? An entity means a legal person. So as we discussed, it cannot be individuals. Second, what are the constituent entities of the group? So if an Indian entity has subsidiaries overseas, all of those become constituent entities of the group. What is an ultimate parent entity? For ease of reference, any company headquartered in India is an ultimate parent entity as far as India is concerned. Any entity headquartered in US is an ultimate parent entity as far as US as a country is concerned. Now, what is portfolio shareholding? Now, if I have, let's say, all these large companies, like we have, let's say, Tata Steel. If Tata Steel has a 5% shareholding in a mining company overseas, then that 5% is excluded because the shareholding is less than 10%. Similarly, when Facebook or Google invested in geo platforms last year, they did not invest more than 10%. They invested 9.99%. For Facebook, the investment in geo is not a subsidiary. It will not get covered under Pillar 2. It is called as a portfolio shareholding. They will not have to worry about looking at what taxes a geo is paying in India when they file their returns, because they are a less than 10% shareholder. As we discussed, only those groups which have turnover of more than 6,600 crores, in 2 out of last 4 years, they are excluded. They are included in the Pillar 2. Less than 6,600 crores, you are safe from the Pillar 2 regulation. So these are the rules, how Pillar 2 is going to act. Like you have Income Tax Act, which has 5 broad heads of income: salary, PGBP, IFOS, capital gains, and house property. Similarly, this is a system of tax. Let's assume that these are those 5 heads under which you will be taxed under Pillar 2. And again, this is top-down approach. You will see if A applies, if A applies, you will get taxed under A. If A does not apply, you will go to B. If A and B does not apply, you will go to C. So it is a slightly more complex system. I will try and make it very simple for the audience here. So the main rule under Pillar 2, that is called as income inclusion rule. So where large multinational corporations, they have to pay a minimum tax in every jurisdiction. Then there is something called as a backstop rule, which is called under tax payment rule. I will take you through each of these rules in detail. I am just laying down what the rule order is. Then there is something called as domestic top-up tax, which is the qualified minimum tax. And then the box in black, that is very important for practitioners. Like today, all of you are giving 15 CA, 15 CB, looking at the treaty and saying, okay, the treaty says 10% withholding, 15% withholding. Once these Pillar 2 comes in, treaties will get amended. Treaties will have, you will have to look at, other than the treaty, you will also have to look at Pillar 2 and see, okay, do I need to withhold extra tax under Pillar 2? What is that tax? So this is the framework. So I have put on my screen a small example, right? So let's see, there are 4 case studies here. This is to test whether Pillar 2 becomes applicable or not applicable. Example number 1. I have turnover of 750 million euros, which is 6,600 crores in all the 4 years. Is Pillar 2 applicable? Yes. Case study number 2. I have 400 million in year 1, 800 in year 2, 400 in year 3, and 750 in year 4. If you see 2 years, I have crossed 750 million, it becomes applicable. Case study 3. There was 1 year I had bumper profits, because of which I was 1,000 million turnover. Other 3 years I had normal profits. Pillar 2 does not apply. You have been less than 750 for 2 out of 4 years. Case study number 4. I have crossed 1,000 in 2 years. It becomes applicable. Now this is the formula. How do you compute whether I have met the 15% rate, I have paid 15% tax in that country or not? So the formula is, Pillar 2 itself is an income tax act. So you will compute taxation under Pillar 2, like how you do an income computation today. You will start with profit, you will make additions, you will give deductions, then you will arrive at taxable income. Same way in Pillar 2, you will start with profit, you will make additions, you will make deductions, and then you will arrive at something called as taxable profit for Pillar 2. So you will also then do tax paid. You will add all the tax paid. You will see some of those taxes you will not be able to count. You will take the pillar, so like how you do income tax computation for your income, you will also do a computation for your tax. You will start with tax paid. You will add some taxes. You will reduce some taxes. You will come to a net tax. That net tax you will apply on the net income and see whether you are meeting that 15% rate or not. Then after that is done, a jurisdictional top-up tax will be applied. So you will arrive at income, you will multiply by the tax rate. For example, if India, let's say Dubai, if Dubai is already at a 9% rate, whereas they have to be minimum at 15%, they will do 15 minus 9, 6% into profit. And on that 6%, you will have to again pay tax in Dubai. While today they have only started with 9, slowly they will go up to 15. If not, because of this law, other countries will go to Dubai and collect that 6% and come back. It is possible under this law. So I have some examples. I thought explaining the law by way of examples will be more easy for everyone to understand. I think the book given by KCA has the course material, and I will take you through a couple of examples to explain all these complicated new tax provisions. So like how there is a charging section in the Income Tax Act, there is a charging section in the Pillar 2 regime also. That is called as Income Inclusion Rule, IIR. So what does IIR do? IIR allocates the obligation on the top-down approach. So if you see the diagram here, we have an ultimate parent entity. Let's say state S, zero tax. For our discussion, Let us assume the state S is Dubai, because as of today it is 0%. Only from July, 9% rate becomes applicable there. So if Dubai holds 3 companies in Dubai itself, company A, company B, company C, Dubai will have to consolidate all the income from all the 4 companies there. So one company may have 7,000 profit, another company may have 2,000 loss, the third company may have 3,000 profit again. So what Dubai will do? They will say 7,000 plus 3,000, 10,000, 10,000 minus 2,000, 8,000 is the consolidated profit in Dubai. Today India does not have a concept of group tax returns. A lot of European countries have a concept of group return, wherein if in that country you have 10 companies, you can consolidate all the 10 companies' income and pay tax. You can set off loss in one company against profit in another company. In India, that is not possible unless you do a merger and move the losses from one to the other company. So in this example, the book profit is 8,000 consolidated profit. Because Dubai is 0 tax, they are paying 0 tax. ETR is 0%. Shortfall is 15%. On 8,000, now let's say in Dubai I actually have operations. It is not a paper entity. I have 1,000 people working there. I have office space on rent. I have computers. I have plant and machinery, etc. Then the law says, okay, we will give you a deduction for whatever expenses you are incurring in Dubai. So they will give a deduction of 500 rupees, and then the excess income will be 7,500. On this they will charge a 15% tax, which is 1,125. So Dubai government will go and recover 1,125 after this law comes into effect. This is the income inclusion rule, where it goes top down. Dubai will go and ask the top company to collect from its subsidiaries and then remit it to the government. Example number 2. Now, we are going one step ahead. Today we were talking in the last example only about one jurisdiction, which was Dubai. Now in this example, let's say ultimate parent entity is in a country like India. State P, HTJ means high tax jurisdiction. India so far was always considered a high tax jurisdiction. Now under the ultimate parent entity, we have 3 subsidiaries. Let's say subsidiary A is in a state A. Let's say it's Malaysia. Malaysia is also a high tax jurisdiction. Subsidiary company B is also in a high tax jurisdiction. Let's say Australia. Australia is also a high tax jurisdiction. And let's say subsidiary company C is in a country like Dubai, which is 0% tax rate, low tax jurisdiction. Now, if we go to the table below, the ultimate entity, as per the consolidated financial statements, has a profit of 2,000. Right? How do we arrive at 2? 4,000 of A plus 8,000 of C, 12,000, minus 10,000 of B, you get 2,000 rupees there. Now let us look at each of the subsidiaries. A has profit of 4,000, B has loss of 10,000, and C has profit of 8,000. And the ultimate parent entity, which is India, it has 2,000 income of its own, apart from whatever is the consolidated income. So in this total, 2,000 income earned by India plus all the overseas companies, if I total it, 4,000 is my total income. Now let's see on a country by country basis. Ultimate parent entity India, 2,000, assuming 30% tax rate, they are paying a tax of 600 rupees. Subsidiary company A, Malaysia, 4,000 rupees profit, 20% tax, they are paying 800 taxes in Malaysia. Company B, of course it's a loss, even though 30% is the tax, they pay 0 tax. Company C, it is in Dubai, 8,000 is the profit, tax is 0, and tax rate is 0 and tax is 0. So on an overall basis, if you see, on 4,000 rupees income, I have paid 1,400 rupees tax, which is 35%. Now what happens after the Globe A comes, after Pillar 2 comes? After Pillar 2 comes, Dubai will put a tax of 1,200 rupees. Then what happens? In addition to 1,400, I am paying 1,200. Totally, I am ending up paying a whopping 65% tax. So if you are on the board of a major company having operations across the world, if you are on the audit committee, this becomes relevant for you, because this law will come and impact you tomorrow. And let's say if it's a listed entity, the shareholders' profits will come down because you are ending up paying more taxes than what you were paying yesterday. Accordingly, this becomes very important, and for practicing professionals, you can look at ways to collaborate with overseas countries or consultants in overseas firms to see how you can help, or you can get this outsourced to India and do it for the world from India. So this is how Globe impacts. So from a 35% rate, I become a 65% tax rate. Going to the next slide. How does the rule hierarchy works? Like I said, Income Tax Act has 5 heads of income. Similarly, there are these rules or heads of income equivalent. How does it work? On the right side, if you see something that is called as DMT, which is called Domestic Minimum Tax. So, State C, which is say Dubai, they can implement this law and they themselves can cover it. Like that 9% minus 15%, that 6% is called as domestic minimum tax. That can be, it can be brought into law by the country themselves. So that is called domestic minimum tax. It remains within the country. Okay. Next, something is called as IIR, Income Inclusion Rule. Now, if Dubai says, yeah, I am not going to do all this, I will still be only at 9%, you do whatever you want. If Dubai takes a position like that, then what happens? Then, the ultimate parent entity, which is India, where Dubai is the subsidiary, India can go and implement these Pillar 2 law and recover 1,200 as per the IIR rules. So, the Indian government will be entitled to go to Dubai or ask its Indian company saying, hey, you have a subsidiary in Dubai, they are not paying tax of minimum 15%, there is a shortfall of 6%, please collect it and give it to me. That is what Income Inclusion Rule says. Next, if that also doesn't work, India also says, yeah, I am not interested in all this. Let Dubai, I don't want to spoil my political relationships with Dubai. I am not going to do this. Then there is something called as a UTPR. Then this company A and company B, which in our example was Malaysia and Australia, they will say, okay, India and Dubai, both of you are not interested in recovering this tax. I will go and recover this from Dubai. So, if you can understand, this is how complex it becomes. First, that country where there is low tax, it will try to recover. If that country is not recovering, the parent entity, which is India, will recover. If India is also not able to recover, the subsidiaries in other countries in the world, like Malaysia and Australia, those countries will try and go and recover it from the Dubai entity. Next, now let's say all these 4 don't work. Malaysia is not interested, Australia is not interested, India and Dubai is also not interested. Now these 4 countries, they will also have transactions with outsiders. For example, if this was Tata Group and Tata Group had subsidiaries in Malaysia, Australia and Dubai, whereas Tata Group also deals with, say, Tata Steel provides steel to, say, Hyundai for making cars, or it provides steel to, say, Ford to make cars. Now then Ford will say, okay, I need to make you a payment for XYZ reason. They will try and do a withholding tax on those payments. That is called as STTR. Because that country where Hyundai or Ford is also situated, if it is a signatory to this, it has the powers to go and recover this or do the withholding of tax at a higher rate. That is why I mentioned, even if your clients are not 6,600 crores in turnover, this may become relevant even for every small payments your clients are going to make overseas. I have made 3 examples here. Now, let's say an Indian company makes payments to various group entities. Payment 1 is equipment royalty paid to a Netherlands company. Now, no tax in India as per Article 12 due to the restricted source rule, wherein it will only be taxed in Netherlands. But Netherlands already has a 25% tax rate. Netherlands is not a tax haven. So, India, you will not be required to do a higher withholding. You will do the withholding only at whatever rate given in the treaty. Second, let's say there is a marketing and procurement fees of 1,000 you are paying to a UAE company. Now, because the UAE company has today 0%, you can still go and do a higher TDS. But this STTR rule says, okay, we are not going to as high as 15%. We want to ensure that that country has minimum 9%. Now, this is the logic why Dubai has said 9% tax rate. They don't want others to do TDS on them and do a higher TDS. So they said, we are 9%, we are out of this STTR net. So if you are making payments to Dubai again, you don't have to worry about Pillar 2 because they are already at a 9% tax rate. But if you are making a payment to say a Cayman Islands or a BVI, British Virgin Island, where the tax rate is 0% today, then you can go and do a 9% TDS there on payments to those countries based on STTR. Similarly, under 194 LC and 194 LD, when interest payments are made, today you are doing only a 5% withholding. But the law says minimum 9% has to be withheld, or 9% should be the STTR rate in that country. So 9 minus 5, 4% extra you should do TDS. That is what this STTR says. In a nutshell, I have simplified this, but it is, as a concept, this is what you need to understand from a practitioner's perspective. Now, how we have computation of income in India? We start with net profit from P&L, then we do disallowances under Section 28 to Section 37, or we do allowances under Section 28 to Section 37, then we allow it net profit. Same way, Globe has a computation mechanism. So what it says is, you have to go from left to right. So my profit after tax is 1,000 rupees. I will do some disallowances, which are called covered tax expenses. Then I will get an adjusted profit after tax of 1,200 rupees. From there, dividend income is excluded. Dividend income and capital gain income is not considered as an operational income. So only operational income need to be considered under Pillar 2. So if it is not an operational income, it is a special income or it is an investment linked income, you will exclude those kind of incomes. So dividends you will exclude, capital gains you will exclude, any revaluation gain or loss you will exclude. If you are doing an internal group reorganization and you are getting a capital gain, those kind of capital gains also you will exclude. Foreign currency losses which are not normal, which are asymmetric, you will exclude those, and any prior period expenses will also be excluded. And then you will arrive at global income. And using this income, you will apply the tax rate and then pay the tax rate in that particular country. So this is a very simple flow chart. So how do you see for your client whether this Pillar 2 will become applicable? Just open this flow chart and see what has to be done. So maybe we can run through it. First, I identify the M&E group. Okay, in our example, let us say this is, let's say, Reliance Industries. So Reliance Industries, whether it is M&E group, yes, it has operations across the world. So it is subject to Globe. But let us say it is a single entity. It has no operations across the world. It is only in India. Pillar 2 does not affect you. You don't have to worry about it. So because it's Reliance, it becomes applicable. Then you see which entities of Reliance it becomes applicable. Like I mentioned earlier, if there are very small entities, 10 crore turnover, 20 crore turnover in particular jurisdictions, say Sri Lanka, Maldives, those kind of countries you have very minimum operations, those countries you can exclude. Then you will perform a consolidated revenue threshold test and you will see whether you are meeting the $750 million threshold across the world. If I am crossing 750 million in the last out of the last 4 years, 2 years I crossed 750 million, I then compute the globe income. After computing the globe income, I do the adjustments, any additions or disallowances, and then I compute the ETR. I see how much is their effective tax rate. And if it is in that jurisdiction below that 15% rate, so I have to see country by country. India, am I paying 15%? South Africa, am I paying 15%? Malaysia, am I paying 15%? UK, am I paying 15%? I will go country by country, see if I am meeting that 15% threshold. Yes, if I meet, then again I will see what is the difference. Okay, I am not paying 15, I am paying 9. In that country, I will go and recover 6. And then, if it is not, I will do all the adjustments. Like I mentioned, if there are any carve-outs, if there are any capital gains income, if there's any dividend income, all of those I can exclude it. And then we follow the rule order. We see whether IIR is there, domestic minimum tax is there, UTPR is there. If none of this is there, whether STTR becomes applicable, and then accordingly we need to take a position. Now, what are the recent updates? So okay, we are in India. Our first question is, okay, if I don't follow, what happens? What are the penal provisions? What are the reliefs? You may say, yeah, I'm in India, there's already 100 compliances to do. In addition to 100, this is the 101 compliance. What if I make a mistake genuinely? What if I'm not able to properly do it? So they are saying, yeah, see, we are going to be lenient in the beginning. We are going to give you some exemptions. We are going to give you some reliefs. So those kind of guidance has already come. Second, they have also already given a public consultation document on the return. Now we are talking about getting data for, let's say in the case of Netflix, they have to get data for 170 countries where they have operations today. How do you get that? Filing one income tax return in India, we are having so many challenges. Filing a return having data for 170 countries, how am I going to reach it? That document is also given out for public consultation and people are looking at it. Now, this is a topic which, your client may not be a 6,500 crore turnover. It may be 500 crore, it may be 1,000 crore, it may be a startup. How does it affect those kind of entities? And let's say if a small company is getting merged into a big company. Today the turnover of the small company may not meet the 6,500 crore threshold. But tomorrow after the merger, they may cross that 6,500 crore threshold. So on a group merger or an entity merger also it becomes applicable. Same way group reorganization. Today we do a lot of internal M&A. There is no acquisition, but I have 20 companies. I don't want to maintain 20 companies. I am merging all of them. Those kind of group reorganizations are also excluded from the purview of Pillar 2 taxation. Now, whether a joint venture, let's say you have a company where your shareholding is exactly 50%. Whilst for accounting standards or Ind AS, you may not consolidate. You may show it as a joint venture. For Pillar 2, it is still considered as a group entity, and you will need to consider the impact of Pillar 2 even where your shareholding is only 50% in that group entity. Now, what are the key considerations going forward? Now, what happens to transfer pricing rules? Today, transfer pricing rules are already there. They will continue even after Globe is there. This is in addition to whatever transfer pricing rules is already there. There may not be any changes made to transfer pricing rules because of this. Now, compliance burden. Like as I mentioned, if you are in 170 countries, you cannot do a manual return for 170 countries. You will need to create an app or you need to create a software which will capture this data or you'll have to integrate this with your ERP. So again, if we are helping clients with their ERP systems, in some way, this may still be relevant for you because you will have to make a plugin to capture the data required for the global information return, which is going to come for Pillar 2. Now, today there are a lot of intermediary holding company structures. Mauritius owns India, Singapore owns India. There is no substance or there is minimum substance in those kind of jurisdictions. Those will need to be revisited after Pillar 2 comes into force. Or even if India is going outbound. For Africa, for example, they go via Mauritius. India, Mauritius, Mauritius, Africa. For US, India goes to UK, UK goes to US. Or India directly goes to US. These are the preferred structures. All of these may need to be relooked at going forward. Second, tax treaties will again be renegotiated. Changes will be made to tax treaties because of Pillar 2. So we will need to also gear up for that. Second, if there is a domestic GAR already in place, how does this interplay? There will be an interplay of both of these. We will need to see how our government is going to come and clarify on these aspects. Now this is a very, very complex set of rules. I have given a very high level bird's eye overview of what is coming. And my request is professionals should start preparing for this in advance so that when it comes next year, we are not taken up as a surprise. And I think KCA has done a wonderful job of bringing such a complex topic to an audience here. Today this is being discussed in BCS in Bombay, it is being discussed in CTC, it is being discussed in a lot of tax-centric organizations. But it is not being discussed in smaller places or let's say even in South India so much. So I think KCA has chosen this wonderful topic and I think members should make use of this and start seeing where you can monetize this. So with this I kind of end my presentation, and if there are any questions, I am scheduled to finish my session by 3. The last 10 minutes are for questions.
In case members have any questions to ask to the speaker, you may please rise and then ask your question.
Thanks for the excellent deliberation on the topic. The question is it both the countries need to enact the laws requiring filing of global information return, or is it only the country from which the management or control of the company is emanated?
So I'll give an overview. See, this is a rule which is being driven by OECD, the law change. Now, India has agreed that they will also participate in this law change when it comes. When I say India will participate, it is a political decision taken by the Parliament of India saying we will also make this law in India. It is a sovereign promise given to 136 other countries. So, India will cooperate with OECD. They will ensure that Indian entities also file returns for this. So, to answer your question, yes, it is both the countries, but the ultimate responsibility will be on the ultimate parent entity. So, this will impact the Indian headquartered companies more than the other countries. But let's say you are a Microsoft. Microsoft has operations in India. Is Microsoft impacted in India because of this? Answer is yes. Reason being, STTR is still there. If Microsoft is under 10AA or claiming any sorts of tax holiday benefits in India, then, or if they are claiming 80JJAA, because of which their tax rate is less than 15%, then it becomes applicable to them also, and they may have to file one return in India and the parent entity will file the global return. So there can be a set of 2 returns required going forward.
Sir, 2 questions I want to place it for you. When you say consolidated financial statements, the ETR should be based on that. Will it be US GAAP, IFRS? Which consolidated standard will be applied in arriving at consolidated financial statements? Number 2, if I have more than one presence in another country, suppose I have 2 subsidiaries, say in Dubai, the examples you are taking, and a branch in Dubai, will I have to make a consolidated financial statements for those present separately?
Yes.
Or how do I make a ETR for that country? Will be my question.
Yeah. So, question number 1, like India today does not follow IFRS or US GAAP. It follows Ind AS. US follows US GAAP. Similarly, each country may have a particular set of standards they are following. Now, the globe has its own rule set, how income has to be computed under globe. So, they will start with whatever is the profit in that country. From that, they will make adjustments. In those adjustments, there can be adjustments on account of accounting also. It will be a starting point will be profit in that country. You will do additions and deductions under globe. You will reach the net profit under globe. Second question, if I am having 2 or 3 subsidiaries or even 100 subsidiaries in a particular country, I will need to do this is a jurisdictional law. So they will treat that jurisdiction as one. Only one return, one consolidated return for 100 entities. So how to knock off intercompany transactions? You will arrive at the consolidated profit or loss, and then you will see whether you are paying 15% tax. If yes, you are safe. If no, you will be attracted by Pillar 2.
I think no other questions from the members. We'll now conclude the session. Sir, your session was really mind-boggling to see how the businesses across the world have been impacted by Pillar 2. We hope that the race to bottom actually comes to an end. And with coordinated system of taxation, it seems like the world is coming much closer than it already is. Thank you, sir.
Thank
I
you.
request CA Nagan Gowda, Chairman, Bellary branch of ICAI, to present a memento as a token of appreciation and gratitude.
A huge round of applause, audience.
Thank you everyone for the patient hearing, especially post-lunch and a complicated topic. I try to simplify it, and the examples used are, to try and make it easier and easier for you. Thank you.
So like you mentioned, I think your session with all the real life examples and illustrations kept us all really engrossed, even if it was immediately after lunch. And at this moment, I would also like to acknowledge that this session was presented to us by Guru and Jana.